Hello, everyone. Today on the Final Bar, I'm joined by John Kosar from Asbury Research in Chicago. We'll talk about the overall market environment, look at the S&P 500 as we're once again making new all-time highs. Let's put it into proper context as we navigate this seasonally strongest part of the year. November, December tend to be pretty strong for stocks. What are the charts telling us about the S&P 500? We'll also focus on sentiment readings, a little more euphoria than we saw last week. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using the charts, the technical analysis toolkit to better understand market dynamics, investor psychology, supply, demand, fear, and greed, all those opposing forces that net out to price behavior. As I mentioned in the introduction, we are now in the seasonally strongest part of the year. It's kind of funny to say that because the seasonally weakest part of the year wasn't too weak this time around. You certainly saw some weakness September into October, but overall the S&P's held up very well. The NASDAQ, the S&P, transport, small caps, mid caps, all making new all-time highs this week. So how negative can things be? Well, it's all about understanding the trend, and then it's defining the risk versus reward. And I love thinking about what's the alternate scenario? What would we see? What chain of events, what charts, what signals would we see that would tell us that maybe things aren't as encouraging as we might assume in November and December? Sentiment could be part of that. And we're going to look at some sentiment indicators, particularly looking at volatility, looking at survey data. Let's look at where those guideposts are, where the current levels are relative to previous extremes, and see if we can draw any conclusions. We have great guests on the show. I'm excited to talk to John Kosar here in a few moments. Coming up this Saturday, we have a special event with Art Hill, who's a longtime StockCharts contributor, called Trend Following Theory, Expectations, and Reality. I don't think anyone can talk the language of trend following better than Arthur Hill. So I'd encourage you to tune in for that one. That's coming up this Saturday, 12 Eastern on StockCharts TV. A couple of great guests coming up for you next week. On Tuesday, the 9th, Larry Tantarelli from Blue Chip Daily. On Thursday, the 11th, Joe Duarte from JoeDuarteInTheMoneyOptions.com. Then the week after, on the 16th, we have Jesse Felder from the Felder Report. Let's continue on with today's show with the market recap. So as I mentioned in the introduction, the S&P making new all-time highs yet again. And, this week has certainly seen renewed strength, not just from large caps. And here you see the bounce after the after the Fed meeting minutes and during the press conference yesterday from Jerome Powell, rallying to the upside, continuing just right on this morning. The big gains were made in the first hour or so of trading. From then sort of sideways, we finished more toward the upper end of today's range with the S&P closing higher about 0.4% to 4680. The NASDAQ composite and then the NASDAQ 100 both up even more, with the NASDAQ 100 up 1.25%. Mid caps and small caps not participating in the upside today. The Dow was flat. Small and mid caps were down a little bit. And we talked about that underperformance of small caps, which has been the reality for the last 6 months or so. But if you look year to date, if you look since the March 2020 low, small caps have certainly been a better long-term play than large caps. We'll talk a little bit about that index as the Russell 2000, the S&P 600, the mid-cap index all breaking out of some pretty long-term multi-month ranges here recently. Elsewhere, we have interest rates back down today. So they came up a bit yesterday afternoon, settled down into the equity close. Today, you saw lower rates with the 10-year yield touching around 151, closing the day around 152, 153. And so overall, we remain in that 150 to 175 range, which was the range earlier this year. That's sort of the springtime range. Then we came down a little bit. Rates got down to 10-year yield, got down to around like 110, 115, and now back up to above 150. And I maintain that long-term thesis that I think higher rates are very possible, if not probable. And I think whether you can navigate that high rate environment or not, I think is going to be key. and particularly in terms of the leadership, right? Growth stocks and value stocks tend to behave very differently depending on the interest rate environment. And I would keep a keen eye on dollar sign TNX. The dollar index, by the way, up another 0.5% today, and that renewed uptrend, or really that consistent uptrend, I guess, in the US dollar, fueling US over non-US. And that ratio continues to favor US stocks over non-US in a pretty big way. Gold and silver actually up today. And the chart of the GLD, frustrating is not a great, probably technical word that implies a behavioral reaction, a mental reaction to the chart. But when I'm coming up with great charts, the GLD is pretty far down the list of those, because overall, what I think gold has demonstrated so far in 2021 is its inability to break above resistance. And what is encouraging about the S&P is the S&P making new all-time highs. What's encouraging about small cap stocks or Microsoft or a bunch of individual names I could throw out here, there's their ability to come up to a resistance level and break higher and follow through. And that is what gold has been unable to do. Now, having said that, let's look at a chart of the GLD here in a moment. When you're looking at the chart of the GLD, I think the evidence I would need to see to turn more constructive is being able to break out. And I think July, August, September, you've seen this ceiling in the GLD around 171, 171.50. And I think getting above that level, which would finally make a higher high, would certainly be a change of character for this chart. The ETF has remained below resistance in September. The RSI has remained in a bearish phase. So remember, when a stock or a price is in a downtrend, the entire range of the RSI will often kind of come down a little bit. And on bounces higher, you rarely get above 60. And that's kind of a great example of that over the last 4 or 5 months. So breaking above resistance, getting the RSI above 60, which just shows there's renewed upside momentum. That's what I would need to see to turn more constructive at this point. The challenge with gold is this bottom series, which is the relative performance. What are you giving up by owning gold and not owning other things? And that's the opportunity cost line. That's the relative strength line. When that's going down, it just tells you you're not being paid to own that particular asset relative to other things that you could, particularly, the large cap equity space. So look at a chart of the S&P here very quickly. And as I mentioned, I think the chart tells you onward and ever upward. And I was asked earlier today, what would you need to see? And my first sort of tongue-in-cheek but very serious answer is that the S&P would have to stop going higher. And an uptrend is made of higher highs and higher lows. And as you see the S&P reach 4550, break out above it, and then just continue in an uptrend that continues to persist. That's not what a bearish phase looks like, right? A bearish phase is indicated by a chart's inability to make new highs, not its ability to just follow through and continue to make new highs. And what the S&P has shown you in the last year is its ability to continually make new highs. You take September's 6% pullback out of the way, and overall, it's been pretty much a relentless uptrend in stock. So, again, we could pull back quite a bit and still consider it a higher low. But if you would get any sort of pullback, which would be fairly unusual in November, December to see it, but it's certainly possible. And for me, that case would involve the 50-day moving average, currently around 44.70. We remain above that. And it's hard to think of stocks as anything but very, very constructive at this point. It's worth noting, by the way, at the bottom, the S&P's RSI is the highest that it's been year to date, right? It's right at that same level that we were in April, just before a bit of a pullback. 3 to 4% decline came soon after that. Just because a market or a chart is overbought does not mean it's going to go down. It does not guarantee anything like that could happen. If you look back at equities just in the last year, you'll find a lot of them, particularly in the tech space and the communication space, where they become overbought and they stay overbought. And that just shows the strong upside momentum that you have in the chart. So worth noting that the market has had a pretty decent run. I think you can tell that from looking at the chart. As always, you remain diligent and look for any sort of pullbacks. But at this point, 45.50, which is the breakout level, probably number one, 44.70, 44.75 at the 50-day moving average. Those are the levels that, as long as you hold that on any pullback, it's hard to think anything but fairly constructive on stocks, I would argue. Elsewhere, very quickly, cryptocurrencies down today, with Bitcoin coming down around 61,000 as we're broadcasting the show here after the close on Thursday. Now, this is Bitcoin coming down from 67,000 not too long ago. So you're continuing to see some deterioration. The problem with that, sort of short-term tactical bearish move is overall the long-term structure, I would argue, still remains very, very positive. Bitcoin and most cryptocurrencies not too far off of all-time highs. Bitcoin and Ethereum that are the charts that are in my mind as I'm saying that. And again, remaining in a pattern, a longer-term pattern of higher highs and higher lows is the key there. Growth sort of working today at the top of the sector return list here to finish off our market recap. You have technology number one up over 1.5%. Consumer discretionary, the XLY up 1.3%. Just remember with some of these ETFs that they are dominated. They're cap-weighted indexes, cap-weighted ETFs really skewed to the higher end of that. So consumer discretionary, about 50% of that ETF are three stocks, Tesla, Amazon, and Home Depot. So if those are doing well, the ETF's probably going to be doing pretty well also, and Tesla obviously doing just fine recently, as the other stocks I mentioned as well, all seeing some short-term strength. So the XOY up 1.3%. After that, on the downside, financials leading the way lower. And we've talked about the importance of that 10-year yield chart. Again, remaining above 150, but kind of coming to the lower end of that range, 150 to 175. The outperformance of the financial sector is pretty much the chart of the 10-year yield. And if not that, it's the shape of the yield curve. And you're looking at like the spread of 2s versus 10s that will lines up pretty well with the relative strength in financials, because that's essentially what a bank's business model is based on the shape of that yield curve. So interest rates coming down today, financials are going to come down. I still could see some further upside in the financial sector if and when rates continue to push higher. And again, I would tell you, I'm always thinking about scenarios that I think people are underprepared for, and the 10-year yield above 175 certainly is one of those scenarios I think people are mentally unprepared for, and probably in their portfolios as well. Let's take a quick break. We'll be back with today's guest, John Kosar. We'll see you in a minute. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So good to have you join us every weekday after the close for our show. We're going to get to today's guest, John Kosar, in just a moment. Two quick comments before we get there. Number one, we love to hear from you, particularly questions that are coming up as you are analyzing your own charts. We are here to help you along your journey of learning the technical toolkit and applying it to your process to make better decisions. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'd love to gather your questions and hope to answer one of yours live on the air on Friday's show. Also, do me a favor and go to stockchartstv.com. That is our on-demand platform. You can see great content every trading day. People like John Kosar coming on the Final Bar, but also hosting your Daily Five along with a series of other really fantastic hosts and guests. You can go to stockchartstv.com, use your email address to set up a free account, or go on your mobile device to any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, joining us on the show once again, John Kosar. John's the founder of Asbury Research based in the Chicago area. I've known John and followed his work for many years, and I'm super thankful every time we get to share some of his wisdom with all of you. John, welcome back to the show.
Thank you very much. It's really good to be here.
So it's good to see you. You know, we're going to talk about a couple different things, but start us out, just thinking about the overall environment. We have this situation where the S&P is making new highs. It feels like a lot of things are making new highs. Is that a problem that we've had this incredible run? How high is too high? Make sense of this for us. How are you interpreting this move?
Well, the first thing that I like to look at is what kind of conviction is coming into the market, what kind of horsepower, how bad do people want to own stocks, and more importantly, to hold them overnight. And the way to look at that, or one way certainly to look at that, is by looking at the total net assets. So we've got SPX up top, which is the cash S&P, goes back to June. And then we have the total net assets in SPY underneath. So what I did here is I ran a 21-day moving average under it, because this is our tactical time period here at Asbury Research. It's one business month, and you can see that it tracked that average pretty well, stayed up above it up until we got into that period, September 20 to October 13th. So we had a little bit of a pullback in the market, but we stopped right at that 384.7 billion area, which was the peaks from July 12th and August 3rd. Stopped on a dime. It actually formed that market bottom in SPX. And then just maybe 5-6 days later, we got back above the 21-day moving average. And then we exceeded the previous peak of 409.7 billion on October the 14th. And now it just looks like there's a race to get in there. So that tells me I've got the conviction for this to go higher.
Now, chart number 2 there. So overall trend appears very strong. Your second chart is looking at the weekly S&P and then the 13-week rate of change on the bottom. Talk us through this one.
So this is the strategic portion of my idea here. When I go into the market, I want to know if I have something to lean on. So this is a 13-week rate of change for the S&P. We have the S&P weekly up top going back to about the middle of 2018. So the two little red strips that go vertically down the chart, those are both periods where we had a negative 13-week rate of change. And those were the two actual corrections that we've had here over the past few years. And then the green verticals are showing you times where we had a positive rate of change. It came back to test the zero line, held and turned higher. Those are strategic bottoms for me. So if we go all the way to the right and look down at October the 8th, it was touching that zero line again. So now I'm watching that, and I'm watching asset flows going into the spider and trying to determine if there's enough conviction to make another bottom here. It looks like we have that. And it also tells you, if you're a longer term trader, now you have something to lean on. You have those, the previous lows that we made during the little 5% dip. That's the place that needs to hold. And this could turn out to be another nicer bottom, a little bit more longevity, like the one we had in Oct 2020, Oct 2019, and May of 2019. So we're kind of hitting on all cylinders at the same time. My job is, I see my job is to try to find the potholes before my clients hit them. And right now, as Dave said, everything looks quite good. I mean, it's a strong market out there.
So you're certainly indicating the strength in the S&P, the strength in the market with two great examples of how that's played out. What, mentioned looking for potholes. What would you need to see to turn less constructive? Because it's hard to disagree. We're in the seasonally strongest part of the year. It seems like a layup that we should be following stocks higher, but is there a particular level or a particular pattern, deterioration in some indication that would suggest to you, all right, we need to be a little more cautious? What would you be looking for as a danger sign here?
Well, we've got an internal metric that we use called the Asbury 6 that I've spoken about in Your Daily 5. And basically it's market internals. It's looking at breadth and volume and high yield corporate bond spreads. It's looking at kind of the under the hood health of the market. And that's very strong right now. The other thing that I would look at is all those assets that are really flying into the QQQ and in the SPY, like we just showed. I start to see those flatten out. That to me will be the first indication that we're losing a little conviction, and that could be the start of something that could eventually turn into a correction. But like you said, the seasonals are strong till about the middle of January. Right now, I wish I had something more to tell you, to watch out for, but this is one of the strongest periods that I've seen this year, just in terms of market seems to be hitting on all cylinders.
It's a bull market phase until proven otherwise. John, listen, it's great to see you. Good to have you back on the show. Appreciate you sharing some of these charts with us. Stay safe, be well. We'll talk to you again soon.
Thank you. Thanks.
That's John Kosar. John's the founder of Asbury Research based in the Chicago area. He mentioned at the end his Asbury 6 model, which I've followed and really appreciated over the years. Last time he was on, if I remember right, we sort of talked through and looked at some of the evidence. He mentioned before we started, 5 of the 6 of the Asbury 6 were all constructive at this point. And what I love about that idea is that as a model that's running in the background, it just tells you the conditions. And if you start to see some deterioration in those conditions, that will tell you should be concerned. But until then, the market's in an uptrend until proven otherwise. Great take from John Kosar there. Let's continue on today's show with our next segment called Getting Sentimental. A lot of the weekly sentiment data is updated Wednesday into Thursday, so it's a good opportunity to take a step back, look at some of the sentiment readings. And as I'll always remind you when we do this segment, I think of a macro technical approach as having kind of 3 components in priority order. It starts with price, then breadth, and then sentiment. And what I mean by that is number 1 is price. I was taught by one of my mentors, Ralph Acampora, if you have nothing else To understand the S&P 500, look at a chart of the S&P 500. Just look at the price, because that will tell you a lot of what you need to know about the market conditions, and all the other stuff, the other information can help validate or qualify what you're seeing in price. The second piece is breadth, which is looking at participation. What are the individual stocks, the sectors, the themes that comprise the indexes? What are those doing? And are they telling you anything different? And then finally is sentiment, which is what people are thinking and what they are saying, either with their votes, with their on a survey, or with their capital, looking at positioning data of some sort. So my sentiment checklist has a couple different pieces to it. We start with volatility. This is a chart of the VIX. Now, again, for me, there's great benefit to the VIX because it shows you where we're at on a volatility basis relative to where we've been historically. The challenge that I have with something like the VIX is when I hear people assigning very specific rules to it, because I think it's a little more nuanced than that. You can't assume that the S&P and the VIX will be inversely correlated. There are plenty of times, particularly on certain timeframes, when volatility and the S&P will go up at the same time, or when they could go down at the same time, because it's not an inverted chart of the S&P. It's looking at volatility. Now, the reality is, when the market takes a downturn, people tend to get a little more excitable, a little more afraid, a little more uncertain, and the volatility spikes. And that's why it tends to move inversely from the S&P. So having said that, I think one of the great benefits is looking at where we're at relative to where we've been. And if you look back through April, May, June of 2021, you can see a number of times where the VIX has hit 15 and bounced higher. We saw that here in early July. We saw that once again here in late October, and now we're seeing it again now. You could argue maybe the second week in August was kind of close to that too. Below 16 is really what we're looking at then. Now, each one of those times, most of those times, you've seen a brief pullback in stocks. And I think that's the key here. The volatility is relatively low, particularly compared to the last year. This is the lowest the VIX has been. And again, it's lining up with some of those previous bottoms in the VIX. But there is no guarantee that the VIX can hits a bottom there and that's it. And the way I'll show you that is if we back this chart up another couple of years, you can see back here in 2019, we actually spent much of the year below 15, actually down in the low teens, down to around 10 or so. So there's a challenge. There's a tactical reading to the fact that the VIX is the lowest level it's been in 2021. The challenge I have with that is there are other years, if you go back during a bull market phase, where volatility has been much, much lower than that. So I find that as more anecdotal. I think that is something interesting to see. However, it's a horrible 4-word phrase to use, but this time is different, or this time could be different, would be a 5-word phrase describing what I think might be a play here. I think you could see the markets go higher. I think you could see VIX go below 15. That is not necessarily a topping sign for the markets. Just tells you the conditions are getting lower and lower in terms of volatility. Now let's look at some other sentiment data, particularly survey data. Two surveys that we tend to look at. The one is the AAII survey, which is a survey of individual investors, and then the NAIIM Exposure Index, which is a survey of money managers. We'll start with the AAII survey. This is the bullish reading in green, currently around 41, 42%. The bearish reading in red, 26%. And the spread between these two is around 15.5%. So what had happened back here in September, when the market hit a peak in early, end of August, beginning of September, rotated lower, you saw the VIX the AAII survey go net negative, really for the first time since, last fall of 2020. Up until then, for the most part, except for 2 random weeks in there, the survey had been net bullish, meaning more bulls than bears, bulls outnumbering bears every week. That started to change there in September. It has now corrected itself or recorrected itself and gotten back to the positive. So where are we at now? Bullish reading is pretty healthy. It's sort of in a healthy range for a bull market environment. It's not excessive. I would see a bullish reading above 50% as more euphoric, excessive bullishness, which is concerning at times, which can be a sign that maybe, everyone's already bought in and no one's left to do it. At this point, I see this as mildly bullish and still pretty constructive. Bulls are still outweighing bears, but it's not at an extreme. There are plenty of bulls out there, but not too many. And overall, I would argue that's sort of a healthy reading. Where you're starting to get a little more in the euphoric level is this second survey, the NAIIM Exposure Index. This asks a bunch of money managers, what's your exposure to equities? 200% long, 100% long, 0%, 100% short, 200% short, and it netted out this week to 108%. That's the second straight week that we've been net leveraged long, right? Over 100%, meaning on average, the net answer is above 100% overexposed, if you want to put it that way, to equities. We've only been above 100% a couple times here in the last 6 or 7 years. The first time was in December of 2017, which ended up being about a month before the eventual high, 4 to 6 weeks before the January 2018 drop into February. Happened again here in, where was this? Here, actually, sorry, it happened a number of times back here. I'm looking at the wrong line here. If you go above 100%, it's when it gets above this sort of horizontal line, that gray grid line in the background. You saw it here in sort of mid-2018, sort of a brief pullback. You saw it again here, let's see, in mid sort of summery months of 2020. This was during, before that pullback in September and October. Then we saw it again in January, February, these cluster of weeks where we were above 100%. So as you can tell by looking back in here, it does not necessarily imply that a top is in, and that's why sentiment data can be a little more challenging. I think it's a little more nuanced than that. But what it tells me is when there's over 100% exposure to equities, it tells me to be on watch for signs that the excessive bullishness sort of ends up with no one left to push the price higher, sort of the end of the bull market phase. Those sort of signals often, if you go back in history, tend to happen later in the bull market phase, not at the beginning of an extended bull market phase. It's also worth noting at the bottom, the Ridex flows, and this is looking at positioning data in the Ridex family. Are people in the bullish or bearish, generally themed funds within the Ridex family? And at this point, similar to the last couple of weeks, it is one of the lowest levels ever, and the chart's inverted just to line up with the other sentiment data that we look at. But 0.07 is the lowest ratio that has been in the history of the series, going back many, many moons. So basically, individual investors using the Ridex family of funds are sort of all in bullish right now. Last chart I just want to show you is the equity put call ratio. We've sort of avoided this for a little while because it's been just mid-range. And while the S&P's gone higher and higher, the put call ratio really hasn't been giving you much. It's worth noting right now, the put call ratio based on just equity options is actually toward the lowest levels that it's been. It's been this low only a couple times here in June of 2021. Again here, February, January, and then December of last year, the only times it's been this low particularly. So again, a lot of times you've had a brief pullback during these periods. Given the consistency of this bullish trend, really low put call ratios have not seemed to be reflected with any sort of topping pattern in stocks, generally speaking. But the last time we saw this was in June. We saw a brief pullback. It was maybe a 2-3% pullback. So certainly something to be watching as options investors sort of get skewed very much to one side of the coin. That is our segment, Getting Sentimental. We need to wrap the show, folks, and go to the 3 and 3 charts in 3 minutes. Here we go. We didn't talk too much about breadth data, but I did want to highlight the percent of stocks above their 50 and 200-day moving averages, because I think it's a really important breadth indicator to understand participation. I think one of the real interesting parts of this most recent upward leg in October now into November, as the S&P's rallied off of its September swing low, is the fact that breadth conditions are improving. That was one of the things that concerned me over the summer, was deterioration in breadth. We had the pullback in September. Now all of a sudden you're seeing a reassertion of positive breadth indication. So 76% of the S&P members are above their 200-day moving average. That's as of yesterday's close. Now over 70% of S&P names above their 50-day. That's the highest we've been in the last 5 or 6 months. So certainly seeing more and more stocks participate on the upside, which is encouraging. Chart number 2, we talked about with sentiment. A number of these indicators are relatively lower at relatively extreme readings. Again, that's no guarantee that prices are going to top, that the market's going to top. Just tells you we're in similar conditions to previous bull market cycles toward the end of that bull market phase. So for me, an extreme reading like that is not a sign to sell for any reason, but it is a reason to look for indications of price weakness and indications that that phenomena is actually playing out in weaker price action. Finally, I throw an individual name out at you. ZBH was a stock that we talked about, and I know with with my market misbehavior premium members. We talked a lot about ZBH. This is in the healthcare space. Medical equipment and medical supplies at times over the last year have been a really good place to be, particularly in a sector like healthcare, which overall has not been a great sector on a relative basis. I want to highlight this as an example of where you've seen price deterioration. I think this is a great rotation from an accumulation phase to distribution phase. It's now breaking down through its September low and the first Fibonacci level. Wouldn't be surprised if we see more potential downside there. That's it from everyone at StockCharts.com. I'm Dave Keller. Be well, stay safe. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.